Hi, and welcome to this morning's early concise highlight. It is currently 7:45 a.m. on Friday, November 20th, 2015. Coming to you a little bit later today because, in fact, we wanted to see, of all things, Canadian retail sales, see if there's any exception to the weakness we've seen on that in the U.S., and there was not. And yet, in spite of that and some further mostly hawkish sentiments on a rate hike from the Fed in December, the equities are up today, as we'll discuss momentarily. And this leads us back to our conclusion that the data probably won't support that. So we have to ask, what does all this mean to the markets? Well, it looks to us like bad news is good news again. All that weak data, and in fact, the S&P 500 is up 7.5 today at 2087. And that puts it, of course, through the high that the market pushed up to yesterday. And it was interesting that in the wake of the Fed on Wednesday, and this was very important, that it had stalled Tuesday into the 2060 to 58 area that had a tolerance to 2063 from the bottom of the gap, from the gap lower going back to last Thursday on the slide down near 2000. Well, the 2063 failed, and it looked like it was coming back under pressure, but could not really get back below the most recent up break at 2046. And now, of course, being out above 2075 to 80, this looks a lot more like a market as of yesterday, that even though it went stagnant and sideways, the fact is that you did not have any rollover back to bearish pressure. And this showed up most definitively in the hourly MACD out above its upper runaway band that dipped back there on Tuesday. By the time we opened Wednesday in front of the Fed, it was already on the push up out of the 2050 area back into 2058 to 63 before the FOMC minutes release. And you can see the impact right here when it finally pushed above 63 during the hour that those were released at 1 p.m. Central Time, that it just encouraged this to be out to the upside. And even though we stalled sideways, it reacted a bit on Thursday. Remaining out to the upside always still favors the bulls. If it's not back below the upper runaway band, the bias is still up. And the next resistances are up at 2100, which it saw a couple weeks ago at the highs prior to the U.S. employment report 2 weeks ago today. And the next resistance is the old 211920 area, the old highs. We'll look at this on the intermediate term charts momentarily. And along with that, we'll look at the old lead contract all-time trading high at 2132 from back in May. So it's 2100, 2120-ish, and 2132 for your higher resistances, and the negated supports, negated resistances, violated resistances we just discussed are your supports now. And that pretty much does it for the short-term view of the S&P 500.